Amazon is a stock that's been on my list to take a look at for a while. I've never really looked too deep into it, but I'm starting to see why it's a pretty good investment. I used to be a dividend investor and I didn't like it because it didn't pay out a dividend. But as I've grown as an investor, I've realized that the dividends aren't as important as I had previously valued them, and really value in the stock is what we're looking for. So, Amazon here is one where the value seems to be somewhere around $150 per share, and it could be worth a little bit more based on the growth rate that we do see for the company. But so far, they're sitting at 173 and a half. They've been as high as 176 this year and as low as 88. That 88 would have been a great time to get in. Discounted cash flows coming up with about 105. Their cash flows aren't the best on this stock, but they are rising. They have invested pretty heavily over the years, and they're starting to find that pays dividends, if you will. Earnings yield, a little low, 4%. They do not pay a dividend. ROE looks really good. Looks like it's partially due to dilution. Their debt does seem to be pretty high. They are growing their assets faster than their debts, so over time that'll even itself out. It would be a big issue if the liabilities were outpacing the assets in growth, but as we see on the 3 and the 2-year time frame, they're not. ROI, 5%. We'd like to see it a little bit higher, but maybe it will in the years to come. And then ROA, the same story there. Their margins are higher than they've traditionally been. They came in at 16.32 this last year compared to the 14 they've had since 2020 on average, and 5.29 net compared to the 4.35 that we typically see from them. Revenue growth, they've been growing revenue pretty well. Double-digit growth slowed down in the recent years, but analysts are expecting it to get back to double digits again, 11.59 and then 11.49. They're expecting even more growth out of the earnings per share, though, of 40 and 34. So that's all going to have to do with the margins, which will likely be adjusting over here. Cash flow growth, they've been up and down with their cash flows. I mean, we can look at it. They had 2 down years, and they've been on a pretty good trend since then. So we are going to stick with the trend that we had seen, 7 to 8% growth year over year. Share count, they do issue some shares. They have been slowing it more recently, and we are going to hope that they continue to slow it. That's one thing there where we would really prefer that they're buying back shares, but if they're freeing up cash for investments by issuing those shares, it may be worthwhile. Assets and liabilities, we already touched on, both slowing down more recently, but the assets are outpacing. We can take a quick look at the balance sheet and see that's a great trend for assets. They do actually hold tangible assets, and it looks very similar to the liabilities. And the only difference here is the assets one goes a lot higher. So getting back to the summary, if we use this thesis here, we end up with average returns of 16.38%. Now, I know this revenue is a bit higher than analysts are projecting over the next few years. AWS and other segments pick up a little bit. I mean, we've seen what's been going on with NVIDIA. We'd hope more growth in the future, which would compound into that 15%. We can take it down, and even if we do 11.5, like analysts seem to be expecting from the stock, at least for the next 2 years, we drop our average return down to 12.5%. So the lever that we have here would then be the margins, because analysts are projecting some pretty big EPS growth. And if the revenue is only growing at 12%, that means the margins are growing pretty well. I mean, at this rate, 5% growth year over year, we'd be getting up to almost 7% within 5 years. And we'd be looking at a earnings per share of $6.28. Now, these are the projections from analysts, and at that 5% growth rate and the 11.5% revenue growth rate, we'd be looking at a pretty big dip in 3 years. So I don't necessarily agree with the analysts on the 2-year projections of this stock. I mean, to get up to that point, we'd be looking at margin growth of 10% year over year, bringing it up to 8.52% in 5 years, would be right in line between 2 and 3-year EPS. Is that possible? Sure. I mean, they do have some higher margin portions of the business that they can grow. So ideally, I think I'd be looking for something more like larger revenue growth than they're expecting, and 8.5% isn't unreasonable for the 5-year net margins. Honestly, I'd like to see that above 10, but they're on their way. So that right there would give us returns of about 18% growth, compounding in the fair value of the stock, where in 3 years, the fair value would be about 184, and in 5 years, it would be 270. With that, buying in at the fair value that we came up with around 150, you'd be looking at slightly underperforming the market in the next 3 years and then doubling the market's return in the next 5, which would not be bad. But the price isn't that low at the moment. What if you bought in at today's prices? Well, kind of flat over the next 3 years. 6% growth, 20% less than you would expect from the market, but still outpacing the market by 9% over the 5-year time frame. So I feel like it's a little high now. It's definitely trading at a 3-year out multiple. I mean, a huge PE on this stock, trading around 175 with a 3 EPS. But there's a lot of growth that people are expecting from it. So, I mean, I personally would try and sell puts in the 150s and try and pick up some shares around there. That would be a much more comfortable position because you never know what's going to happen in the next 3 and 5 years. Maybe things don't pan out with some of those higher margin segments of the business, or a competitor comes in and takes a lot of the market share. $146 would be the ideal price, personally, that I'd be looking to get in, where the 3 years is on par with the market and then 5 years is by far outpacing. And anything below that would be perfect. I mean, a value investor would want another margin of safety of 10 to 15%. With this stock, I think we could go a little bit lower. So in that case, you'd be looking at trying to get in around 132. Definitely not unreasonable. I mean, it's been as low as 88 in the last 52 weeks, but definitely have to keep an eye on it. So this one, I think it's a buy. It's a wait. It's not completely unreasonable at today's prices, but it is trading at 3-year out valuations. And if you can get it closer to current value, you'd, of course, get better returns over time. So I want to thank you guys for watching. Please like if you enjoyed the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.